morning. Welcome to the 2022 Catholic Foundation Investment Forum. I'm Nancy Coveny, the president of the Catholic Foundation of North Georgia. We are pleased to provide you with an opportunity to be with your fellow Catholics, to learn more about the Catholic Foundation's investments, and to hear from an investment expert on global equities. Some quick housekeeping. In order to get you back to your office and homes and end promptly at 10:30, we will not have any breaks, but feel free to take them as needed. The restrooms are to the right of this room. There are other restrooms towards the front of the club and to the left before you exit the building. Also, please feel free to refresh your coffee, which is out there, and to take advantage of the lovely breakfast as the morning progresses, so you can get up and do all this as you need. We have gone through the questions that were submitted with the registrations, consolidated some of them, and assigned them to be asked of the speakers. If we are unable to get to your questions, please stay after the program. Rod and Michael will stay to answer any investment-related questions, and Brent Herron, I'm not sure where Brent is, right back there, will answer the questions about charitable giving. Now I would like to ask Father Sonny Punnakuziyil. I've been practicing. Pastor of the St. John Newman Catholic Church, who is also a member of our Pastor's Advisory Council, to come up and lead us in prayer to begin our session.
Good morning. Let me ask this. Do you know who is the greatest investor of all? Who is the greatest investor? Jesus. I saw a pastor answering that question. Why? Because Jesus saves. Well, I am Father Sonny, pastor of St. John Newman Parish. Nancy tried well pronouncing my last name, Punnakuziyil, It came close, Nancy. I heard she was practicing all night, But thank you, Nancy, for inviting me to be here with you all. It's so good to be with you all this morning. Thank you for your support of the Catholic Foundation of North Georgia. Now, before we pray, let me briefly share with you what we do in our parish. I'm pastor of St. John Newman Parish in Lilburn, and a few years ago, I was asked to represent our deanery, Northeast Metro Deanery of the priests, to be a member of the Pastor's Advisory Council. And I gladly accepted it. I didn't know why. While speaking with our parish business manager, Mr. Paul Hayes, he is here with me, along with Tom Stewart, our parishioner, we thought it was a good idea to have a plan to invest for our parish. And I think it was a good idea. I'm sure we all know how important it is to have some future financial security for every parish in the light of the fast-changing financial situations in parishes now. Our investment is not that huge at present in St. John Newman, but I can say it is consistently growing. We have set up a second collection to support our endowment fund, and we are trying to educate our parishioners on the future benefits of this endowment account. We have also designated estate funds to the endowment fund, and we have it also as an e-giving option on our parish website. We also had invited Juliet is here, no? Juliet some time ago to our finance council to speak to our parish finance council to explain about the benefits of this endowment fund. Naturally, parishioners would love to leave a gift to the parish because that's their second home. But unfortunately, many parishioners don't know that there is an option available. So that's where the role come in for us, like pastors and parish leaders. Okay, let us pray. In the name of the Father, and of the Son, and of the Holy Spirit. Amen. Lord our God, bless this assembly here today. All the board members, participants, and our respected speakers of the Catholic Foundation of North Georgia Investment Forum. Guide us with the power of your Spirit to be good stewards of your gifts by using them wisely for the welfare of the faith communities we serve, through Christ our Lord. Amen. In the name of the Father, and of the Son, and of the Holy Spirit. Amen.
Good morning. I am Mike Petrik. I'm senior counsel at Alston and Bird. Senior counsel is, in large law firm language, just a euphemism for retired. So I have to keep busy, and among the things I do, I attend Mary Our Queen, which is in Peachtree Corners, which is a neighbor here of Dunwoody, not south of the airport. And I chair the pastoral council there, and I also have been volunteering for some time, 8 years now, at the foundation, at the Catholic Foundation, and I'm the current board chair. So obviously, I care deeply about our mission. And that mission, of course, is to help Catholics make a lasting difference in our Catholic community by ensuring that this community, our community, has the financial resources to serve our current and future generations. My wife and I believe, in thinking about those future generations, that it's particularly important to support Catholic education, which is why we worked to create an endowment for St. Pius, and we did that working with the foundation. What does our foundation do? Well, we're celebrating our 30th anniversary, so we've been doing a lot. We're celebrating that in June. I would like to give a round of applause, kind of a premature happy birthday. And so we've been working and are working with Catholic donors who believe in our mission. That is, they share our love for Christ Church and want to do their part to ensure that our community, Catholic community, continues to thrive. Thanks to those donors, as of the end of last year, we have accumulated $115 million of managed assets that includes almost 400 endowment funds and donor-advised funds. Again, thanks to those, from these funds, we can make grants that benefit our Catholic parishes, charities, ministries, schools. Last year alone, we distributed almost $3 million. None of this would be possible without the wonderful generosity of our donors, and those include many of you here this morning. Among those supporters of both our foundation and our mission, our next two speakers, Rod Hennek and Michael Butkus. Both are partners of Atlanta Consulting Group, one of Atlanta's most prestigious investment advisory firms. Rod is a founding partner, having previously worked for Morgan Keegan and Merrill Lynch. A graduate of the Air Force Academy, Rod actually chairs the investment committee of that august institution's Association of Graduates Endowment. An Eagle Scout, Rod and his family attend St. Anne. Michael has been with the group since 2013. He advises a wide range of clients, including endowments, foundations, retirement plans, family offices. He's a Clemson grad, and he had previously worked at Credit Suisse. Michael and his family attend Christ the King. So now it's my pleasure to let Rod and Michael come up and tell you a little bit about Catholic values.
Thank you for the warm introduction, and thank you to Nancy, Juliet, Leslie, and the whole Catholic Foundation team. Great efforts put into this morning. I told them earlier that my kids thought it was really cool that I got a postcard in the mail with my picture on it. So incredible promotions. Rod and I serve as the investment advisors for the Catholic Foundation. We've done this for over 10 years, and our organization has over 3 decades of working with Catholic institutions. We have 21 people, all based here in Atlanta, and we serve approximately $14.6 billion of assets under advisement. 20 of our 90-ish clients are Catholic, and that's about $3 billion of assets. And our role is really to serve as a co-fiduciary alongside the investment committee to think through some of the things we're going to talk about today. And so we spend a lot of time on asset allocation, manager selection, and we're going to talk a little bit about performance, but where we really add value is on the subject matter I'm about to get into here in a moment. So for those of you that did not live stream or follow the tweets for the USCCB in November, and yes, they did live stream it, and they have an excellent Twitter account for you Twitter followers, very active. the conference met and discussed their investment guidelines for the first time, well, not discussed, but made changes for the first time since 2003. So if you think about the investing world, there have been a few changes since 2003. And so they met in November and they approved their guidelines. Now, before I get into some of the changes, we want to make a few things clear. And if you read this letter, we'd be happy to provide it. Shoot me an email or LinkedIn and I can send you the letter. The first principle is to exercise financial stewardship and to obtain a reasonable rate of return. So our goal, your goal as Catholics, any Catholic assets you oversee, you have a fiduciary responsibility. The second principle and second goal is ethical and social stewardship, which is what we're going to focus on here. Now, it's important to note that this USCCB guidelines, they're not a requirement. Those are set up for the bishops. Those are set up for them to think through their process. It's really more of a good place to start for other Catholic organizations. So they have three major investment strategy themes here. Avoid doing harm. So that's divestment from companies whose businesses may run counter to Catholic values. Simply put, that's things like contraceptives, abortifacients, things that traditionally Catholic investors have said, we will not own any company in our portfolio that may produce these things. The second is actively working for change, shareholder engagement, proxy voting, et cetera. This is something that's in the news quite a bit in this day and age. For those of you that follow the investing world, Larry Fink, who's the CEO of BlackRock, in his 2021 shareholder letter, talked a lot about shareholder engagement and talked a lot about how there's more and more shareholders that are getting involved. And I think the pressure that puts on companies makes them react quicker to any sort of engagement. I think the best example in the world we're living in right now would be if you followed BP very quickly, divested, took a $25 billion write-down given what happened in Russia. So before anyone engaged them, before anyone came to them and said, you own a bad company, you have a bad investment in Russia, they said, we're going to divest of this. And then third is promoting the common good, community development, labor relations, and affordable housing. It's a little bit harder to define. That's a little bit more of an impact investment. And the good thing in terms of being Catholics and with the Catholic Foundation here is that's the end goal of most of the dollars that are invested with the Catholic Foundation is those donors are using those funds to invest and promote the common good. Now, for those of you that have kept up with the Pope's encyclical Laudato Si, I think that was in 2015, saving our global common home has become a very common subject matter. Now, the good news, too, is that's become a common subject outside of Catholic circles. So this addresses environmental issues, climate change, and use of natural resources. The other topic that was largely publicized but not covered as much in the recent update was fossil fuel divestment. In fact, the conference came out and said they wanted to leave room for advisors and organizations to determine their own policies. Why is that? Some organizations like higher education, clients we work with, college endowments, they may choose to divest. A lot of Jesuit institutions have said, we're going to divest of all energy-related companies. Well, they have to take a look inside and say, well, where do we get our energy, right? They may get their energy from coal. So are you actually divesting when you're getting certain energy resources? There are other groups that say, instead of divesting, we're going to engage. Right? We're going to actually own these companies, and we're going to engage them as shareholders to see what they're going to do and what kind of common changes they're going to have. The best example really there is the companies that are most likely to have said changes are going to be the large energy companies because they're investing the most money in alternative energy resources. So, promise not to read too much here, but on this next matrix here, which I think everyone has in their book, this goes through the policies that gives kind of where we stand and what sort of updates were made. The first one is protecting human life, something that's very common as Catholic investors. No investment in companies involved in abortion, et cetera. But they made two updates to this. The first being language recommending no investment related to IVF. Well, that's not incredibly obvious at first because not a lot of companies report that. And so we're going to have to work with sort of MSCI and some of these companies we use to get the research to see what percentage of the revenue is coming from that. It actually may run counter to the next one there, where it's added engagement. And I want you to really underline that word engagement because you'll hear that quite a bit today and really as an investor going forward is engagement guidelines with companies for affordable access to life-sustaining drugs and vaccines. So one of the things we're having to wrestle with here is what happens if a company provides IVF but also provides life-sustaining drugs and vaccines? And as investors and Catholic investors, we have to weigh those two and see what percentage of the revenue comes from one versus the other. and really just take a step back and say, what's more important? Promoting human dignity. This is something that's a little bit more of a gray area sometimes, because companies don't necessarily report revenue like they do for other things with some of these negative human dignity issues. Gender equality, human rights, and companies distributing pornography have always been part of the screen, but what we're starting to see more so is addressing human trafficking and forced labor. So think about Nike and forced labor many years ago and how they had to clean up their act in Asia. And then also adding encouragement, engaging with companies to promote Catholic understanding of marriage and sexuality. So engagement means not necessarily divestment, right? If you're going to engage a company on their issues, you most likely have to be an owner of said company. So it's less divestment, more engagement. Enhancing the common good. So this is divestment from weapons producers, gambling companies, and tobacco. But they've added language encouraging engagement with social media and telecommunications companies to promote guidelines as understood by church teachings. So think Facebook, right, and Instagram, and some of the issues you're seeing raised with young people there as investors engaging those companies to have better practices, to have better resources, better technologies to protecting young people. Pursuing economic justice, engagement with companies to increase ESG reporting standards. So for those of you that were here 2 years ago, thanks for coming back. You may recall I had a huge matrix that went sort of left to right, from traditional investing on the far left to philanthropy on the far right, and in the middle they had traditional investing, socially responsible investing, ESG investing, impact investing, a lot of things that you're looking at me confused at this point. Well, what we've started to see is the Catholic investing realm start to move a little bit more towards the middle there, where it's not just divestment, it's moving towards some SRI and ESG standards. ESG investing, which has been popularized in Europe for decades, is starting to become more and more popular here. If you were to just go Google ESG, you'll see many more products that are offering ESG standards. The problem with that is everybody's definition of ESG is different. And so what you have to look through is, what are those ESG standards, what are people doing, and then also how are underlying companies reporting on these ESGs. Big picture here, I already gave this example, but that impact investing is investments that actively address the common good and positive social and environmental change. So there are companies out there that may be working towards, like BP is probably the best example right now. They divested because of that social change. That's a big social impact. Really, you're seeing that across the board from a financial standpoint, where just about everyone has said, we're going to divest from Russia right now. And so people are truly voting with their dollars, but what's interesting about that is that companies are doing it before they're engaged by the shareholders. So we're living in a world where that engagement is happening before the underlying investors has to go to them. Finally here, saving our global common home. This is really looking at climate change. The UN came out this week, if you didn't see the news, with some pretty scary reports about what's going on in this world, and the Pope's been very focused on this. So there's an active investment in companies with emissions reduction goals. The common phrase there is net zero. So if you Google net zero, you'll see that, ironically, the companies who have most of their compensation, CEO compensation, and the most goals with net zero are going to be what? Energy and utilities. So if you purely just divested from energy and utilities companies, you're taking money away from the companies that are actually trying to have the greatest change. And then finally, engagement to encourage high environmental standards, water-saving policies, biodiversity, and et cetera. So what do? We work with the Catholic Foundation and our Catholic clients to look at some of these issues. Because if you just said, we want to get rid of companies that are flagged for environmental issues, one of the first companies that would be flagged, given where we are here, would be Coca-Cola. Anyone have a guess as to why you would not own Coca-Cola from an environmental standpoint? What's the number one ingredient? Water, right? And you think about where Coca-Cola is most popular in emerging countries, it uses a lot of water where they might have strained water resources. But if you turn to the second page, which we don't do anymore, right? You just read the first page of Google. You'd notice that they're actually investing the most in clean water and energy resources for these areas. So really the conclusion of this letter is there's a lot more gray area than there used to be. That's good for us with helping our clients, maybe a little bit harder for you as investors. But I think as Catholics, it's helpful because it's less so just this one stringent, don't do this, don't do this, don't do this. It gives you more opportunity to look at things and have that opportunity for change. We think it's an exciting evolution for Catholic values. We think the ESG and engagement component of what they've added to the USCCB letter is important. And then we're also seeing better and better reporting from this data, right? I can't help the Catholic Foundation unless I understand what Coca-Cola is doing. Now, Coca-Cola is now required more so than usual to put those sustainable components of their processes in there. Different investment managers, I'm sure Ariel has maybe an ESG section on their website that probably didn't exist 10 years ago. And everybody's just improving the reporting standards such that investors have a better opportunity to understand what they own and what possible changes they're investing in. I guess I'll have some opportunity for questions here in a moment. I'm going to turn it over to Rod, who's going to give you a little bit of a portfolio update for the Catholic Foundation.
Thanks, Michael. I'll Andy around the thing so I don't have to do two or three things at one time. Is this on? Yeah. Okay. At the Catholic Foundation, we have three specific strategies: long-term, conservative, and a balanced strategy, which is managed by the Christian Brothers Investment Services, which is primarily for the gift annuities. So we're primarily responsible for the two strategies, which are long-term in nature, higher risk profile, can be more aggressive for a higher rate of returns. And then the conservative strategy is more focused on a much lower allocation to equities, a higher allocation to fixed income, and has an income component. So and thus we have really two kind of pools that the individual investors can select with regard to where they want their money to go. The screen here shows the long-term portfolio, has approximately 65% target allocation to domestic and international equities, 23% in fixed income, 10% in alternatives, and I'll discuss that in a minute, and has a 2% cash weighting, although because of your generosity and the efforts of the Catholic Foundation, that's been kind of tough because you keep bringing money in all the time and not distributing it based on that. So it's been a wonderful advocate of not only getting great returns to grow the portfolio, but in collaboration, the great way of contributing to that has helped this portfolio grow to, as we've talked earlier, over $115 million. So that's really phenomenal growth. The long-term strategy you can see on the left-hand side shows the allocations. The single largest allocation, no surprise, is large cap equities. That's a passively managed portfolio by State Street that follows the US CCB criteria, so it is socially responsible. So it's a passive allocation. We also have another index fund, the Christian Brothers S&P 600 index fund, again, another socially responsible index looking at the 600. For the investment professionals, those are small cap stocks that are much more higher quality, so they actually have earnings. If you've looked at the Russell 2000, almost 30% of the stocks in Russell 2000 don't make any money. So this is a higher quality portfolio that does that. You'll notice there's a lot of names on here, and that's intentional. In small cap, we have two managers. In fixed income, we actually have 21% of the portfolio, and it's divided among three different categories. We also add an infrastructure. We have infrastructure in the portfolio prior to the most recent passage by Congress to go in infrastructure. That wasn't in anticipation, but thinking that's a great area because it's an income generator. And then we also have three different strategies in the alternative space. On the right-hand side, we identify the managers. And you can see going on the right-hand side, 39% is in the two passive index funds, the large cap and small cap. Delaware makes up the other active piece in small cap. And then in the international category, we have Ariel International, who is managed by our next speaker, Rupal. And then we have a WCM-focused international growth strategy. Ariel manages a large cap value strategy, so we like to have complementary styles. So we've matched them with WCM, which has more of a growth orientation. And that combination is very powerful in anticipation of all different things that are happening in the market. We also have exposure to international small cap and emerging markets, which obviously have been difficult, but long term, we believe they have really good value and undervalued today. In the fixed income area, as I said, three strategies make up about 18.8% today. And that's probably one of the most challenging areas, which we all know with interest rates going up. We've been saying that for a couple of years, but we know the Fed tells us it's going to happen. So we're trying to have three strategies that are going to be complementary in anticipation of interest rates going up. So we have a couple shorter duration or shorter maturities to kind of prevent that, but also or help us give some risk enhancement by giving us a downside protection, but also trying to get some yield by adding a couple strategies that give allocations to higher yield strategies as well as emerging markets. And then finally, in the alternative area for us is not to necessarily enhance returns, but give us downside risk. So all three managers have strategies that are very different from the market. Ironwood Partners, which is a fund-to-funds market neutral, their sole purpose is don't lose money. And in fact, what's interesting so far to date, the market's down 8, 9, or 10%. I don't know what it is today, Rupal. You probably know more than I do. They're actually flat, and that's their intention. And in fact, they have about the same amount of risk as a fixed income portfolio that have outperformed significantly. And then it's complemented by two other managers, Renaissance, which is a classic long-short, more of an algorithm, if you will, smart black box. Wonderful portfolio, has been a little volatile, and then we complement it with a firm called Canyon Balance, which is in the distressed debt market. So a nice combination. All three of those funds have done significantly better than the market. Both Ironwood and Canyon are actually positive this year. Think about that. With the overall market down, they're positive, and actually Renaissance is maybe down 2% and the market's down 10%. So their issue is not to hit the ball out of the park, as you think most hedge funds do, it's to give us that protection when the market gets difficult. Now, to complement that strategy, we go to the conservative portfolio, and its focus is much different. The overall allocation, instead of almost 65% equity that you see in long term, the allocation to equities here is 40%. So automatically, that has a lot less exposure to equities. We complement it with a higher allocation to fixed income, which is approximately 58%. You'll see a number of the same managers, but there are some additional ones to try to increase that income focus that we talked about. On the right-hand side, again, we still have the largest allocation here is that passive index fund by State Street, but you'll notice it does not own any international small cap, does not own any emerging markets. But in the fixed income area, we've added a couple other strategies. The Naveen Flexible Income Fund, this isn't an advertisement, but it's primarily a fund that uses corporate debt, preferreds, and emerging markets to give you some exposure to higher yielding securities, so generate income. We complement that with a short duration high yield fund. What does that mean? Buying high yield securities that have very short maturities, 2 years max. So it gets a higher yield and we don't have the duration risk. And then finally, we added the PIMCO Diversified Income Fund, which is an all-weather fund that's emerging market debt, high yield, and also can do some investment grade. And so it helps us in anticipation of playing defense in fixed income in a market we think will be challenged with an interest rate environment with, we all agree with inflation, is probably going to go up. The last thing you see one additional strategy, real estate, and this is the DFA Global REIT Fund. Real estate was wonderful last year, it's done very well, but the other complement here, it's got a big dividend yield. So the enhancement here is to try to take this portfolio, make it more conservative, but also generate a very substantial amount of income as much as possible without taking a lot of duration risk. So we're looking at that as a complement to do all those kinds of things. The final strategy is the balanced strategy, which is run by CBIS, or Christian Brothers Investment Services. And as I said earlier, this is the purview where we allocate all of our charitable gift annuity funds. On the left-hand side, you'll see kind of a similar allocation to long-term, very similar with regard to almost 60% plus in equities. And on the right hand, it shows you how it's allocated. Now, the allocation actually is in all different types of Christian Brothers investment funds. So you'll see the names here don't show the managers. That's because each one of the categories have multiple managers inside of those. And the other thing about Christian Brothers, they do a great job of allocating and implementing Catholic values in their structures. So those are the three funds. Of course, the end of the day, how have you done for us lately? So if Mike we'll show you the 12/31/2021 performance numbers. The long-term portfolio, which at the end of the year was just short of 100 million, we couldn't quite get there, but we would argue we did pretty well with a 14% plus return last year. You'll see the longer-term performance, and you'll also see below that this thing called balanced index. To give us some parameters, how are we doing? Each one of these investment categories or managers are compared against a specific benchmark. So to kind of give us a scorecard, if you will, we take those weightings of those benchmarks for each one of those managers and aggregate them up to a balanced index. At the end of the day, if the managers are adding value over and above their respective benchmark, that will be reflected in their actual rate of return. So you can see across almost all these time periods, except for one period, the last 2 years in long term, we've done pretty well in doing that. So that's what we call added value. The other thing that you're not seeing here, and we do this with the investment committees, we look at the overall risk. So it's important to get real returns, but it's also important to look at the risk factors. And then we would show you another 4 or 5 pages, and I'll press this over to Michael to kind of explain all of that. So we didn't show that to you today, but to remind you, it's not only how much return we can get, but commensurate with the amount of risk that we're taking for the portfolio, and that's really important. Conservative strategy, as you would expect, almost 55, 58% in fixed income, only 40% in equities. Wouldn't have quite the returns, but one would argue, I think a return of 10.55 and a 5-year return of 8% looks pretty good compared to what's going on in the bond market today. And then finally, you see the balanced strategy. That is a newer strategy for SIBIS. It only started in June of 2018, so it's only been available for a couple years, but it's actually off to a really good start, primarily because of the higher allocation to domestic stocks in the United States. The other thing that's important is all of the returns we're showing you are net. In other words, these aren't gross returns, and you have to subtract that. This includes the manager's fees, Michael and ours fees, the custodial fees, and also the expense ratios that the Catholic Foundation of North Georgia. So we're particularly proud of a program that we think is providing competitive rate of returns with reasonable expenses that are charged in. So with that, we're certainly happy to take maybe 4 minutes worth of questions before we turn it over to our main speaker. Oh, she's shaking. We got more time than that. Okay. Happy to entertain any question. Dick.
The fixed income market is one that's kind of baffling me. What are your thoughts because of the incline here in interest rates and what Powell said yesterday? It's not a long-term feeling about, I say long-term, 2 years feeling on fixed income.
Okay, so Dick's going to ask me what my crystal ball looks like. And what I'm really going to do is refer that to the investment advisor over here that's going to answer that. But you have to remember, when I got in this business a long time ago with you, Dick, when I got into business, the 10-year Treasury was yielding 15%. And I was at Merrill Lynch, and I couldn't get people to buy a 10-year Treasury at 15% because they could put their money in a money market fund and earn 16 or 17%. Let's flash forward to today. Those money market funds pay you, besides nothing, with Fed funds rate between 0 and 25, and now they're going to go up 25 basis points. So certainly, and with what's happened with inflation, with COVID, and all of those things, we know interest rates are going up. And so I can't tell you, you see all these pundits say, well, they're going to raise them 4 times, 6 times, 8 times. I don't know, Dick, but clearly we're going to see interest rates going up. But I would also tell you, do you know what the average Fed funds rates have been over the last 30 or 40 years? It's about 3.5%, 4%. So really, where we've been living because of COVID, the financial crisis, the money that's been put into the markets, the buying of securities has been there to kind of keep our economy going up. At some point in time, it's got to stand on its own. So, and if I think about it, 25 basis points going from 0 to 25 to 25 to 50, really? But it's more an emotional reaction that we all have, what's going on with interest rates. So clearly some of us that are getting older that have gray hair or no hair, it used to be, we'd invest in fixed income for income, and that's the challenge today. That's where you're going. So, we're trying to be diversified. That's why we showed you different strategies here. We're looking at all kinds of income producing things as additional alternatives to when interest rates do go up, and maybe we feel more comfortable with that. The timing, I don't know, and that's why we're going to defer that to Rupal, because she's going to tell you exactly what's going to happen when she's up here.
I think the only thing to add to that is, last year we had a lot of clients, not the Catholic Foundation, who came to us and said, well, why do we have any fixed income in our portfolio? Look at the return prospects for fixed income. Why would we have that? And we have to have a long-term view and continually say, listen, it's about diversification. It's a long-term view. This is the ballast of your portfolio. And I certainly couldn't have predicted what would happen this year, but I think a lot of investors are pretty happy to have fixed income as the ballast of their portfolio, albeit some negative returns. It's certainly better than equities. So I think that long-term focus and diversification benefits of having it are really the advantage we have as long-term investors versus individuals that may have shorter time horizons or different ways of looking at things.
I have a question. So in the beginning, you talked about the policies around protecting human life, right? Promoting human dignity, they feel in line with Catholic values. And then I look at, you've got a pretty reasonable allocation to international equities. So how do you navigate the human rights violations that might be considered not in line with these policies or egregious in international investing activities, whether it's country-related or company-related?
So when we select managers, we have some great software that helps us look through and look at every manager. When we hired Ariel, we very quickly knew, what would be the violations. But it's understanding those violations and more so understanding the processes of the underlying managers because they're picking the stocks, right? So it's unlikely that we would go hire someone that has a 50% violation and owns a bunch of really bad companies, right? And so I think understanding what you own, and then we regularly run these screens to understand what every single one of our managers owns, and then we can go to them and say, well, wait a minute, this company seems to be a really bad company with a bad track record. Why do you own them? And so the good thing for us is we can, again, we seem to be deferring to you a lot, but is go to those managers and ask them, okay, what's going on with this company? Because oftentimes we found Marriott was a great example of a security that used to screen for pornography. And so we wouldn't own them in the portfolio. But we had a manager come to us and say, well, wait a minute, we want to own them. And we said, well, that doesn't align with our values. And they said, well, listen to this. They've actually let all their contracts expire. They only have it in a few emerging markets countries, and they're no longer going to have any pornography in their hotels. Well, that's a great example of a manager coming to us, helping us think through that, and then allowing that stock to enter the portfolio. And so I think it's just a matter of disclosure. You really can't get away in this environment with having a bad company doing bad things because people are going to call you out on it. And I think the investing public, be it investment managers, individuals, have better and better detail to say, I'm not going to give them any money. And you're also seeing the index providers, be it BlackRock or Vanguard, stepping up and saying, we're going to be part of this process too and help you think through that.
What are you doing to address the Bishop's addition of the environment to socially responsible investment context?
Yeah. Sure. So this is in regards to the Bishop's guidelines in regards to the environment. It's the biggest gray area. I'm not gonna lie, especially in front of a room of Catholics and priests. But it's really hard to define because, as I said earlier, there's two different ways to address it, right? You obviously don't want to own any of the major violators, right? If you're a really bad company that is mining in South America and creating a lot of waste, I'd hope that would be disclosed and people are going to understand it. And B, I think there's just a lot of opportunity to invest with some of these companies and then understand it. So we're really still in the early stages because, as I mentioned, even the bishop said, we're not going to touch this. We're not going to give specific guidelines. We're just going to say, try and do good things. And so that's a matter of working with managers, looking at our index providers and our research providers to say, what's the best way for each client? Because every client is different, right? If we were to poll this room, right, or poll our committee, every single person might have a slightly different view on the environment and what's good or bad or how you engage them. The good news is we're seeing more products, so we're seeing climate change strategies. So maybe it's something where you carve out a portion of your portfolio and you invest in the companies that are putting the most with net zero, companies that have committed to net zero. Maybe it's an additional screen on our portfolio, which is probably the most likely first step, is know what you own, right? And do we own any major violators? If we own those violators, then we go pick on Rupal and her team and say, why do you own this company? So it's really starts with information. It starts with building that framework, understand what you own, and then eventually make some changes. And I also think that there's going to be more and more opportunities to invest in products that might be specific to this. There's something called Laudato Si University. And so there's just more and more information here, and I think we're still in the digestible stage. To be honest with you, we were really excited because we thought the bishops might actually give us guidelines. They might say pretty specifically that we're going to help you out, we're going to give you a list, and even they deferred. And so this is a no answer other than to say we're looking into it and we're getting better and better information to look at our portfolio and see what best fits us.
That's called a political answer. I would also underscore the goal here is to have our portfolio as socially responsible as absolutely possible. That's our goal. But we're also pragmatic, as Michael said, the two principles, the fiduciary responsibility to provide financial assets for the growth of our Catholic values. So that's why this is full disclosure. We're transparent to look at everything and present this kind of thoughts to the investment committee to have dialogue about it. So it's not hidden, but it's out front so that we can decide. And as Michael, I think, very well said, it's still gray area. When the bishops won't even touch it, they're leaving it us to that discretion. And that's when we then go to the Rupals of the world and help us understand. And she's got great stories about the impact of some of these companies that are in certain businesses, but they're trying to change that for the good. And I think that's at least deserves some dialogue with regard to those decisions.
Could you touch on the distinction between the long-term and conservative portfolios, please?
The biggest distinction is the equity exposure. Long-term is focused on a much more longer-term strategy, let's say 5 years plus, maybe 10 years. And because of that, it has a much higher allocation to equities, acknowledging they have a better return profile, but much more volatility. So because of that, that allocation is over 60%. On the other hand, conservative, because it's primarily, we don't want as much volatility, so it has almost 25 to 30% less equity exposure, so that's number one, and has a much higher allocation to fixed income-like types of securities. Now, as Mr. White questioned, with fixed income at some of the lowest rates we've seen in history, that becomes quite challenging. So that's why it's got some other additional fixed income alternatives and strategies to try to complement that. So in the end, it should get the difference between the two. Long-term will have a much better long-term profile, but it's also going to be more volatile. For example, so far this year, that portfolio is down a little bit compared to the conservative portfolio because it's got fixed income. That said, fixed income's been challenged because with interest rates go up, fixed income goes down too, but not quite as much. So that's the complement. That's why we look at it that way. I mean, so the other side is the conservative. We try to generate a certain level of income, but that becomes challenging when interest rates go down. So that's why we've complemented it with short duration high yield. We put REITs in there, which is real estate investment trusts that pay a dividend yield, and it has an infrastructure piece that also has dividends. So we're trying to look at other income sources to complement the conservative strategy, which also makes it less volatile over time.
Also, just to know, all of the endowment funds are in the long-term strategy because endowments by nature are a long-term investment, except for one, which is the Conrad's Family Education Fund, which is a lot of you who are from schools get the benefit of grants from that fund. And that was established in the 1990s with a trust that particularly said it had to have an income-only spending policy. So the conservative strategy is not only trying to be conservative, but it's also trying to produce more income so we can give more grants out from that fund. And that's why sometimes how much we have to give away to the schools out of that fund varies based on how much income that fund is earning. And to people who have donor advised funds with us can put them in any of the three strategies. But we really discourage endowments from being in the others. We put them all in the long term, if we can.
Your real assets area in the long-term strategy, 4.9%. Can you give us just a bit of a background of what that real asset strategy is? And do you try and keep that around 5%? These commodity markets, wheat, oil, and everything else going crazy over the last couple months. Is that on the higher end of the commodity real asset area, or do you try and keep it around 5%?
Convenient timing, given that it's done really well this year, and so in general, I think it's been about 5%. One would argue, okay, we're in an inflationary environment, and given how well real assets have done this year, it obviously would be a lot higher. But if you were to look kind of again, this is the long-term view, and this is what we have to focus on because there's been a long period of time where real assets have underperformed, right? And then we have people on the flip side of this saying, well, why do you have this in your portfolio? And so we go through an asset allocation process that looks at a 10-year asset allocation. So, we could get into an environment where, that could go a little bit higher, but my guess is that it would probably be around 5%, just given the long-term nature of the entire portfolio. So historically, it's been around 5. It could go to 0, it could go to 10 if we felt particularly strongly, and this is not us making predictions. Rod and I do not sit there with a whiteboard and say, this is what we think real assets are going to do next year. We take a long-term view, and we have a very quantitative process to look over a 10-year period and say this is the opportunity. Rod mentioned international small cap and emerging market stocks. Not looking too hot this year, right? But I'd say if you look over the next 10, 20 years, right, they're the most undervalued and there's the most opportunity there versus U.S. equities, which have had just a tremendous run. We have I thought I'd just point this out real quick. If we had stood in this room 2 years ago and talked about what we thought the returns would be, right? And you think what we've lived through, right? I imagine a lot of us saw each other was 2 years ago, and poor Christina Hooper stood up here and said, COVID's not a big deal, it's a buying opportunity, no one knew. And look at those returns. Rod and I would have never stood up here and said we were gonna do 12%, almost 13% net. And so, we never really can predict the cycle of these returns, and you think about the market we've had over the last 2 years. So it's taking that long-term view, setting roughly a 5% of real assets. It could increase, it could decrease, but that's probably what it's most likely going to be. Great. Well, thank you for your time. If you have any additional questions, please speak with us afterwards.
Thank you.
Good morning. I'm Fritz Holzgrefe, known as the speed bump between now and our keynote speaker. But I'm president and CEO of a company called Saia, based in Johns Creek, just up the road. About $2.5 billion revenue company, 12,000 employees across the country. We're in a transportation and logistics space. I've been involved with Catholic Foundation for probably 10 or 11 years. As a board member, as part of the Finance Council or Finance Committee throughout the process, got to see the great results delivered by Rod and team over the years, saw the growth of the foundation, commitment to core values, the Catholic principles. It's been so exciting for my wife and I that as I rotated off the board, we established a donor advised fund, because we liked what we saw, what had been built, and what the opportunity was. Our family were members of St. Peter Chanel Parish. My kids are Queen of Angels, Blessed Trinity graduates. I've got Notre Dame grad, got one on the way through. So we're embedded in the Catholic community, and we see the values in this fund, or in this organization, and the reach and the touch that we've seen across the diocese. So it's been spectacular, and really appreciate all the great work that Rod and team have done to help develop that. So get to the keynote. Rupal Bhansali is the Chief Investment Officer and Portfolio Manager of Global Equities and the co-portfolio manager of Ariel Global Concentrated at Ariel Investments. Rupal is a first-generation immigrant and a woman of color who came to America with no network or no net worth, but managed to break through the glass ceiling on Wall Street to become a chief investment officer. She's a serial entrepreneur who built and grew 3 multi-billion-dollar international equity businesses, first at Oppenheimer Capital, then at McKay Shields, and now at Ariel Investments. Throughout her 25-year career, the mutual funds she has managed have often received the coveted 5-star rating from Morningstar, which reflects top decile performance. She's been featured twice in the Barron's list of top 100 most influential women in U.S. finance. She's known to be a contrarian investor and unconventional thinker, and literally wrote the book on non-consensus investing. You'll get a peek of that in her presentation called The Power and Payoff of Non-Consensus Investing. Rupal, welcome to the conference.
I can't help but help Rod and Michael here out on this very provocative question of ESG. So before I even begin my presentation, I want to see a show of hands of how many people in this room think that more sales of Tesla is good for the environment. Electric vehicles, isn't that good from an ESG standpoint? Who thinks so? Raise your hand. Really?
They know you're trading.
Okay. You've been teed up. Okay. Obviously, you're all correct. You know why? The conventional wisdom is that Tesla, because it's an electric vehicle, obviously not releasing any greenhouse gas emissions, which is obviously the whole focus of climate change, must be good for the environment, and therefore should be sort of the poster child of any ESG-driven strategy. This is a wrong way to think about it. And to give you a perspective of how ESG is so complex and really requires some non-consensus thinking, is because ultimately, any electric vehicle, by definition, requires electricity. So what really matters is not just the car, it's how electricity is generated where that car is sold. And a lot of Teslas are going to be sold in China. And China produces electricity using the worst form of energy, coal. So indirectly, you've actually done something far worse rather than doing something far better. And I just wanted to sort of give a shout out to Atlanta Consulting Group and advising you to be more holistic and go deeper than the headlines. It is really important because you can end up with very unintended consequences if you don't think through the second order effects. So anyway, that's your non-consensus ESG thought for the day. I'm in America. Nothing starts out without a compliance disclaimer, and if you can't read the fine print, what it really is telling you is don't believe a word of what I'm saying and don't rely on anything that I'm recommending. All right, with that, are we going to talk about Steve Jobs in Silicon Valley and Billy Beane and sports in an investment presentation? Well, obviously, I told you this was non-consensus, so we have to kick it off with topics that appear very far away, but actually are extremely aligned with the field of investing. I think you all know that what Steve Jobs did with the iPhone is he revolutionized something in two ways. Before, you had to be like a nerd to figure out how to make the phone more effective. So you had to be very smart because a phone was very dumb. Now it's the opposite. We all can be very dumb. The phone is smart. That's an amazing accomplishment, right? Because now we all feel like we are power users as opposed to Luddites. I, for one, am very grateful. And he sort of refused to settle, for the suboptimal equation that many people did before him, that you had to be smart. And if you tried to make the phone complex, only then could you make the phone more functional. He insisted the phone can be smart and simple. That's really hard to do. Billy Beane, he revolutionized the game and the business of baseball, right? And I know many of you, if you've not seen Moneyball or read the book, obviously talks about how he revolutionized. Before his arrival, most people were used to losing games and losing money if you owned a baseball team. He said you don't have to do that. You can actually win games and make money. You don't have to pay up for talent. You can identify it in a smart way, and you can achieve the and proposition of winning games and making money. Before his arrival, people thought it was not possible, just like Steve Jobs. And so this brings me to investing. When I started out my career, people keep telling me, well, if you want high returns, you have to take high risk. And if you want low risk, you have to settle for low returns. And I'm like, it doesn't sound like a good option to me. I want to change that equation. And so my investment philosophy draws from the kinds of investment approaches that Billy Beane took or Silicon Valley took. And that's what I'm going to talk about. So why is it so hard to succeed in beating the markets? A lot of people know that investors, routinely fail to beat the markets over the long run. So active investing has been vilified a great deal. Part of the reason is, and certainly I'll tell you, DIY investing is fraught with underperformance. Individual investors typically don't measure their performance, so they don't know how poorly they've done. And as human beings, we like to tune out our mistakes. Thank God for that, because we couldn't live with ourselves if we kept those in mind. So it's really important to understand what is different about investing is that in most things in life, if you have the answer correct, you're off to the races. If you're a student and you're giving an exam and you get the answers correct, you're going to ace it, and that's great. If you're a lawyer, you give the right precedent, you quote the right argument, you win the case, right? Being correct is the be-all and end-all of what we have to do in most things in life. In investing, that's not the case. If you are correct, but everybody else also had the correct idea, it's already in the price. It's the consensus view. And if you thought Microsoft was going to report $10 of earnings, and Microsoft reports $10 of earnings, ergo, you are correct. Will you make money? No. Because everybody else already knew it was going to make $10 of earnings. That's what it made. You're correct. But you're not non-consensus. So what it takes in investing is not only do you have to be correct, but you have to prove everybody else's view incorrect. Your correct view must be non-consensus. That is the trick. But here's where it gets really hard and asymmetric. What if you're incorrect? Being correct is not enough, but what if you're incorrect? You're going to lose a lot of money. So this is why investing is so hard. Not only do you not score any points for being correct, you score penalty points for being incorrect. In terms of, though, if you're correct in non-consensus, the beauty is you score big wins. And that's what we call in sports or an election, right? What is the unexpected outcome? What's not priced into the odds? An upset victory? That's what I'm going to talk about. So this is kind of how you can score an upset victory and be correct in non-consensus, or what it takes to be incorrect. And believe me, that X factor, which few people realize, is quality. Now, any manager you talk to will say, I buy high-quality companies, right? Of course. I mean, whoever admits to owning crap? And you know, it's a growth manager, value manager, whoever, like, I'm buying quality, I'm buying quality. Well, here is the secret. Quality is routinely misdiagnosed by the market. Everybody is seeking quality, but they don't know how to understand quality. And God forbid you misunderstand quality and you're incorrect about the quality, you're going to lose a lot of money. And remember, this is sort of what you want to avoid in investing. And I'm going to sort of tell you that if you are able to identify quality that others have not identified to be high quality, so you're correct and you've proven everybody else wrong, you can make a lot of money. That's why it's a motherlode of opportunity. But if you misdiagnose quality, you can end up losing a lot of money. So the whole name of the game of doing fundamental research, what I and my team do for a living, is figure out what is the true quality of something as opposed to the headlines. And that is what I'm going to talk about in terms of case studies. So here's what happens. You know, in the diagnoses, when you go to a doctor and you have a medical test done, etc., right? You're trying to figure things out. You can have this notion of false positives and false negatives, right? And that's bad because you're looking for the answers and you're getting the wrong ones. And so that's sort of the notion of this whole quality. Keep in mind, misdiagnosing is this notion of false positives and false negatives. So an example here is a company that some of you may be aware of, BlackBerry. How many of you used to own one back in the day? There you go. It used to actually be nicknamed Crackberry, right? Because we couldn't live without it. You know, that's what the spouses, you know, said about their, oh, he's with his Crackberry. And you know, back then, BlackBerry revolutionized, again, the user interface because they had this advantage where you could get what was then called push email. I don't know if you remember that phrase, but that was huge because before we used our phones for calling and then, you know, data, and now we could stay connected with our office, etc., because we could get email. And that was very important to get it in a timely fashion. And also, you know, people thought that initial adoption was going to be by corporate enterprise, you know, the business users, the professionals, but it would proliferate to the consumer over time, right? That's how technology tends to waterfall. And so all of those sorts of prospects, you know, were priced into the stock, right? That was the quality and profile of the company that people understood. And people also thought that not only would this work in the US, it would work globally. So the addressable market opportunity was huge, and that's how the stock was priced. So this is kind of, you know, the conventional wisdom of the day was this is a success story, this is a winner, let's back it. Of course, what happened? I'm going to talk about the low quality business that turns out to be high quality, and then I'll give you the example of BlackBerry, which was perceived to be a high quality business, turning out to be a low quality business. So let's talk about, we were on the topic of cars, and so we're now on the topic of tires, which obviously most people think is a commodity, right? I mean, the conventional wisdom is, what is a tire? It's been around forever. You know, it's a pair of wheels. Who cares? And you know, it's sort of this sticker shock you get. I don't know if you've gone to replace a set of tires. I mean, it costs you more than a freaking laptop, right? And so you're just like, whatever. And generally speaking, people think that the correlation of owning a tire company and its prospects are when car sales are booming, you know, you kind of think all the auto component companies' stocks should do well, because again, that's the thinking in people's mind, cars, car components. And that's sort of the conventional wisdom. And because these companies in the tire industry are viewed to be commodities, low tech, you know, overpriced, and frankly, not that important, the stock market values them on very low multiples. So basically, people think it's a low quality business. And historically, the numbers on these companies, you know, return on invested capital, which is a true measure of profitability, has been very low. So the facts seem to support the view, right? And that's sort of really the challenge of diagnosing quality. But here's the problem with those facts. They're backward looking. Yesteryears, tires were just a pair of wheels. But of late, and I say of late in the last sort of decade plus, and especially now, tires are a mission critical component because the better the quality of the tire, it really supports fuel efficiency of a car. And guess what? We're all trying to reduce greenhouse gas emissions, right? The tire is critical. And more importantly, the tire is critical from a social standpoint because it's very important for the safety of a car. The way you measure safety ratings is how quickly the car tire has a braking distance from the time that you brake it to, you know, how quickly it comes to a stop. So safety and fuel efficiency are such important imperatives. And again, you see the whole ESG element, you know, into these sorts of investment ideas, which you don't think of up front, but it's really embedded in every company in every shape or form. And here's the real kicker. Not only is it a mission critical component, it's actually very high tech. You may not realize this, but Michelin, which I think you know is a very leading tire company, and Bridgestone, Firestone, these are the brands you hear about. Bridgestone is a Japanese company, and Michelin is a French company. And you know, a lot of their manufacturing of tires takes place in France, in Japan, in America. And you have to ask yourself the question, how is it when all of manufacturing has been outsourced to China or like some low-cost country, why do these people produce in these high-cost countries? Why? Because it's actually a very technological, complex thing to do. Do you know the higher the diameter of the car, the vehicle, and so now we're all driving SUVs, so we need 17, 18-inch diameter tires, not the usual 16-inch compact car tires, right? That's sort of so yesteryears. The bigger the tire, the harder it is to make it round. Go figure. 18-inch tires will cost you way more than 17. 17 will cost you way more than 16. Just an extra inch is a game changer. And when you go into electric vehicles, by the way, which is, you know, coming up, the spec of the tire has to be even greater because a battery engine is heavier compared to a gasoline engine, and the heavier the payload, who has to support it? The tire. So you can make 2x the profitability in electric vehicles or 3x, and the market shares that you get in that industry are even higher because the Chinese companies cannot make those high-spec tires. And so I'm just giving you a sense for how this is actually such a crucial component on so many vectors, and that these companies, you know, Michelin and Bridgestone, et cetera, are at the vanguard of that phenomenon where they're investing in technology to make these things perform to expectation. And so they're extremely good in terms of providing also value for money, which, you know, if you look at the sticker shock, you would say, no. But they last longer. So you have to amortize the cost over the 4 years that you're going to drive the car. And guess what? And by the way, if you're in the market for tires, buy Michelin. Because they're actually cheaper. And the reason they're cheaper is because they last longer. And the tread, which is very important for the safety profile of the car, you know, the braking distance, it does not wear down as fast. So again, you're getting more value for money, which if you don't think through it this way, you will actually think I'm just paying up. And this is why the companies, the smart consumer eventually figures out, right, that this is actually value for money. I mean, you can't fool a consumer all the time. There's a reason why they're able to charge this high price and still have this high market share. So this is an example of where also what really drives the tire industry is the miles driven, not the new car sold. Even if it's an old car, and right now used car sales are big, but you still need the tire. And so tires depend upon miles driven, and we're actually driving more. COVID. You're not taking the plane or whatever. So you understand this is the non-consensus, unconventional kind of way of looking at it from a forward-looking perspective. And if you did all this research, the way we do it, you can make 2x the money than the benchmark. So you score your upset victory twice as much. It's a huge amount of outperformance with far lower risk, because you're priced for all the bad news, but you're not priced for the good news. So hopefully I've given you a sense for you can achieve higher returns without taking high risk if you do research in a way that proves your view correct and everybody else's view wrong. Isn't that a lot of fun? Proving everybody else wrong? Okay, so I told you misunderstanding quality was the biggest mistake. So now we talked about how you can make money. I'm now going to tell you how you end up losing money. We talked about BlackBerry before, so I won't go into these points. I'm sorry. And I think you all know what happened to BlackBerry. It wasn't a high-tech company. It was just a consumer electronic company. And why is it important to really characterize it as a consumer electronic? Because consumer electronic products are hit or miss. You know that, right? I mean, some gadgets will do fantastically well and others will flop. And that's not a business that's high quality. That's just a very volatile, and you can't really predict success with any degree of conviction and so it's really important to not misunderstand quality. And what happened with BlackBerry is what people thought was a superior user interface. Well, guess what? Something else came along with an even better one, right? The touchscreen. Because before we liked the QWERTY keyboard, and we thought, that was like, oh my God, I love it. It's out the window. Things change. And so what was at one point a company with a lot of competitive advantage, it became an eroding advantage. What was supposed to be multiple opportunities became multiple threats. And of course, the rest is history. The stock has not done well at all, to the point where it's really, who even knows that this company exists, right? It actually does. But it's a fraction of its former self. So now, you would say, gee, that's a layup of a story. Give me something here and now. And so I'm going to talk about Apple. Apple is a darling stock. Apple stock has done extremely well. And there are so many investors out there who think I'm a genius because I bought Apple, 10 years ago. And of course, look, you've made a lot of money. You'd be right to think you're a genius for that particular investment, but you can't really replicate it, right? And so if you can't replicate something, it's luck, not skill. Serendipity. Because for every Apple that you could have bought, there are many other stocks that you could have bought that you didn't make money. And so I'm just going to share with you, what if Apple goes the way of BlackBerry? What are you going to do then? The litmus test of research is not what you're going to do when the stock is going up. That's easy. It's when the stock is going down. Are you going to double down or are you quitting? That's the real research that will allow you to take the right action. And so in the case of Apple, look at the parallels. It's obviously viewed as a high-tech company, but guess what? It's just a consumer electronic company. And it has a lot of flops. Siri is a failure. iTV is a failure. iHome, and when I say iHome, people are like, what? It's a spectacular failure. You don't even know about it. It was the Alexa equivalent that really did not take off at all. And so there are lots, and maps, all sorts of things, right? They've been a failure in many areas. Now, of course, the iPhone keeps doing very well, and it keeps, bailing them out. But iTunes is a failure. Spotify has taken over, and they shouldn't have, right? And so I just want to give you examples of, we are so conditioned to thinking that this is a success story and everything is going right. Actually, just one thing has gone right for it, and that's the iPhone. And they just got lucky during COVID that all of us needed to rely on our phones so much that we upgraded at a very fast replacement cycle. But remember, this is just a device. And I know people say, oh, I'll never give up my iPhone, but you don't have to. You don't have to. You just have to replace it every 4 years instead of every 2 years, right? And if you do that, the revenues of this company halve. 50% decline in revenues, just from that alone. And so for a growth company, you don't have to disappear. Somehow people just keep thinking, oh, iPhone's never disappearing. I'm not arguing that it's disappearing. All that a growth company has to do is disappoint, as Facebook or Meta and Netflix discovered, right? All you have to do is disappoint. So if that happens, what seems to be a lot of opportunities can turn out to be threats. And a lot of people may not realize this, but iPhone is not that successful internationally. It's a US phenomenon. It actually has far lower market share, and Android is the platform of choice, which is a Google software. This is what happens with Heyday versus Mayday. So the blue line is the BlackBerry chart. Once upon a time, it went up spectacularly, and then it crashed. And look at where the Apple chart is, just with a 10-year lag. So I thought that would be some food for thought. Anyway, so having said all this stuff about making money, not losing money, I want to sort of help you understand how this translates into a performance track record. Because most people think, again, conventional wisdom, that to make money in the markets, you have to pick the hot dot or the hot stock, right? The winner. But it's about avoiding the loser. It's winning by not losing, which is the title of the presentation today. And you'll see the power of the arithmetic, because again, people don't think through it this way. It is about do no harm and not losing money. And all the conservatism that Michael and Rod talked about is super critical when it comes to investing. A lot of times we get very greedy. Oh, I didn't make as much money as the market went up. But the critical thing is, how much risk did you take in making that money? And if you took more risk, it might come back to haunt you. And that's sort of very important to understand. And so in my book, risk is just defined as losing money, right? How else is risk defined? It's not standard deviation and volatility and all this. It's losing money. And return is making money, okay? And so let's see, why is it that it's so important to avoid the losers? Because you always lose money from a higher number. And you make money from a lower number. That's all you have to teach your kids, really, and learn yourself. If you have $100 and you lose 50%, it goes to $50, right? Let's say you make 50% and you think, okay, minus 50 plus 50, I should be back where, no, because you're making that 50% on the $50 now, you only go back to $75. You're losing 25%, my friends, okay? To make back the $100, you need an idea in your portfolio that's going to go up 100%, twice as much as what you lost. And to add insult to injury, even after you come up with this 100% idea, you're only at break even. You've not really made money. Now imagine if you had this, and it's very hard to come up with 100% winning ideas, let me tell you, markets are efficient. But let's say you somehow managed to come up with this 100% winning idea. But you had only lost 20% on your losing idea. So now from $100, you would have gone to $80. If you put that 100% idea to work to the $80, you're at $160. You've made 60%. So you see, the difference is not in your winning ideas. It's in the losses you make on your losing ones that you want to really avoid. And this is how it plays out in a track record. So imagine if I showed you a manager. This is a hypothetical illustration, but I just want to make a point here. Over a 10-year period, this manager delivered 7% returns compared to 3.8 for the benchmark, which is a resounding 3.6% annualized outperformance. You're going to say, gee, I love this manager. And I'm going to put all my money with this manager because it's an amazing track record to beat the markets by, almost twice as much. Most people don't do this. You know why? Because they look at performance not this way, but this way. And when they look at it year by year by year, typically how people show performance is, what did the strategy do, which is the first column, this hypothetical portfolio's performance, and the second column is, what did the benchmark do, whatever it is, the S&P 500 and etc. And every year, calendar year, they look at the two and they compare it and they say, oh, you were underperforming, outperforming. And guess what happened with this manager? The green shaded section is the period when this manager outperformed the benchmark in that particular calendar year. And the gray shaded section is when the manager underperformed. So if you're tracking this manager year in, year out, you're like, oh my God, get rid of this manager. 6 out of the 10 years, they underperformed. Their batting average is really poor, right? And you don't like this manager and you get rid of them. Because 3 years in a row, look at 2003, 2004, 2005, this manager underperformed. You're like, oh my God, what have you done to me? You're terrible, you don't know how to manage money. But here's how you really should look at performance. growth of $100. Always look at performance in absolute terms, not relative terms. By the way, in every prospectus of a mutual fund, one of the first pages the SEC has made this mandatory decades ago, but nobody reads the prospectus. But there's a reason they do this. You have to show performance as growth of $100 because that's the right way to look at performance, but very few people do. So again, this is something you're learning today. Growth of $100. See what happens. You've given this manager $100, and the last column is, the benchmark. After 2 years, because the market declined, remember the tech wreck? We had like 15, 20% declines year after year. Imagine that. And so the market declines from 100 to, I believe, and I'm so sorry I can't read the numbers, but 88, thank you. And the manager declines far less. And so what happens is, even though in year 3, the benchmark is up 35%, and this manager is only up 25%, that's 1,000 basis points behind. 10 percentage points. That's like, oh my God moment, right? But look at what happens in growth of $100. This manager is up 10% because they go up 25% on a bigger number. Whereas the benchmark goes up 35% on a smaller number. Go figure. And so this lead, look at $110 compared to 88. It keeps continuing even though the manager underperforms for a couple of years. And then, of course, every once in a while, you will beat even a rising market, and that happens. The yellow shaded section is 2000. Think of the peak of the bull market. After 5-7 years, you have the peak of the bull market before another one sets in. Even at the peak of the bull market, despite underperforming for more years, this manager is still ahead than the benchmark. And then, of course, a crash comes. Think the great financial crisis, for example. Markets are down 40-50%. This manager is down far less. And so even at the worst time of the market, this manager is up 45% compared to the principal amount given. So you've still appreciated your capital. Whereas with the benchmark, you may as well have put money, cash under the mattress. And so this is the power of winning by not losing. I hope I've illustrated this for you. It's not about frequency. It is about order of magnitude. And it's about winning by not losing. So how should you avoid losses in your portfolios looking forward? Because the rubber meets the road. Philosophy is great. How do you apply it in practice? So the last 20, 30 years have really seen an influx of money into passive, into quant, into growth, into the US markets. And I'm going to tell you, your foresight portfolio should think of doing quite the contrary. It's probably time to rethink active. I just showed you the power of active. If practiced correctly, you can make a lot of money. You don't have to settle for low returns. You can actually reduce risk. And you can identify a lot of value if you're a bottoms-up investor because you're looking at companies holistically rather than as just a number in a quant portfolio. The other thing that I would argue is dividends are going to become a much larger portion of returns because capital appreciation, which is what we've been used to, is extremely challenging given where valuations are in markets. And whenever valuations are rich, you can actually experience capital depreciation, which is what we don't want. Remember, no losses. Losing money is the albatross of making money, okay? So do no harm is avoid losses. So be careful how your portfolios are positioned because, exactly when performance looks great, it's when it might be reversing course. And exactly when all the 5-10 year numbers look great, like it happened for BlackBerry, and you think, gee, this is great, you could write it all the way down too. Physics, semiconductors, 1970s, 80s, 90s, and today, that was a way to play Moore's law, and it revolutionized a lot of industries. But today, it's not about Intel. It's going forward, I would argue a foresight portfolio should bet more on biology than physics. Healthcare, all the different diseases. We are having an aging society all over the world, and it's a fact of life that as you age, you need more help with your health because your health deteriorates. And biology works with the body because you're getting your body's own immune system, and we own a lot of healthcare companies in our portfolio that are looking to solve real unmet needs of the world today from a healthcare perspective. Healthcare is one of the singular sectors that have derated in the S&P 500, believe it or not, over the last 20 years or so. There's not a lot that is out of favor. Healthcare, not the sexy biotech stocks that shoot up during COVID, etc. I'm talking about general pharmaceutical companies. There's a lot of opportunity all over the world. And then, for some reason, people don't want to put their money in cash. It's like you make no returns, but remember, a lot of people are invested therefore in junk, which is called high yield. They're deluding you into thinking it's high yield, it's high income, right? Everybody loves those high yields. But what happens with junk? Misdiagnosed quality, you can lose a lot of money. So I would be very careful in terms of thinking about being what I call pound foolish and penny wise. Tech was deemed to be the new consumer staple. What if I told you it's going to be telecoms? Without fiber optic broadband networks and internet connectivity and Wi-Fi at home, life is over, okay? Wi-Fi is a new 4-letter food. So, telecom stocks, nobody even thinks of them, right? I mean, they're not even the darling, but they are the new consumer staple. And consumer staple companies like Procter & Gamble, etc., fine companies, no issues, but they're very expensive because all the quality is already in the price. It's a consensus view, right? Whereas telecoms are not the consensus consumer staple. So again, if you think about certain sectors and opportunities in a very different lens, you can come up with some great investment opportunities in what is otherwise a pretty richly valued market. And as I think Rod mentioned to you, I literally wrote the book on non-consensus investing. He wasn't kidding. And I especially want to encourage, if you haven't, I don't expect you to read it, but if you wanted to read a special chapter I wrote for women in particular, which is the last chapter of the book, I have posted it for free on my website. Again, same name, Non-Consensus Investing. And it's really career advice for women, but also investment advice. And if you have a young daughter young colleagues, female colleagues at your office, please share this particular message with them, because I have heard from women all over the world that it's been quite inspirational for them and instructive for them, because as you were told in my introduction, I came to this country with nothing. And I believe that if I could become something, anybody can become anything, because I am not special. Everybody can do what I've done. And if I can play some role in that, in the women in your life, I would just be very honored and grateful. So thank you, and I'm happy to take questions. Yes?
The market has had a rough start to the year, which is maybe another statement. But where do you see potential trouble, and what are some of the risks that investors?
I'll repeat that question. The markets had a rough start for the year, and so what are the stresses or troubles, areas that I see ahead? First, I would actually disagree. The market has not had a rough start. Falling less than 10% is not a rough start. That's just normal, par for the course. The fact that we've not had that for a decade is what is challenging, that we think that a single-digit correction is a big deal. It actually isn't. It should happen more frequently. Now, that said, I think the market is due for a much more rougher environment, and so I still do see troubles ahead, and I put them in 4 buckets. I call them the 4 L's. The first L is you really want to avoid, because remember, I'm not going to tell you what to own, I'm going to tell you what not to own, to avoid the losers, right? Loss-making companies. The indices are not down that much, but underneath the indices, if you see where the real pain is in the market, it's in loss-making companies. I mean, companies falling 30, 40, 70%. And I told you, when you lose a lot of money, I mean, forget it. When you lose 90%, and it's not impossible in some of these, high-flying stocks, you need to make 900% to go back to break even. Try coming up with 900% ideas. It's try not to lose the 90% in the first place. So loss-making companies, first L. Second L, leveraged companies. People have gorged on debt. And when you look at a P multiple, it does not show up. So what you really need to look at is not just a P multiple, but the debt multiple. Few people do that because, corporate debt was not such a big deal. People used to pay down debt. Now it's like a badge of honor to take on more debt. It's like the astute capital optimizing structure to, if you're a CFO. And you get an interest deduction, right? So, tax-wise, it's a way to fund. Again, low cost is not the same as low risk. And just because debt is cheap, remember a lot of people in the housing market took HELOCs and interest-free loans and all this, low interest rate loans for the first couple of years. Well, guess what? At some point, the debt has to be repaid. It's not just the low cost, it's the high risk of the debt. So don't confuse low cost and low risk. Leveraged companies are going to be in for much more trouble going forward. So that's the second L. The third L is companies whose stocks have lofty valuations. And by Jove, there are many, many out there, especially in the US market. Some of the most egregious valuations are in the US market. And today, in the global benchmark, the US accounts for over 60% of the market cap. That's 60. There are 49 other countries that account for the balance 40. Okay? And that includes Japan and Germany and France and Netherlands and Switzerland and, big countries out there. And so whenever a country, becomes like the darling and this sort of, it's almost like an article of faith that, I'm going to put my money in terms of what's worked best. That's like a hindsight bias, not a forward-looking bias. You always want to position your portfolios for what's going to happen in the future, not what's happened in the past. Because remember, the other big thing that the SEC always tells us is past performance is no guarantor of future results. These adages are supremely important to file away. So I would argue, in line with, of course, what Rod and Michael, who've already told you, that the opportunity to invest for capital appreciation and less capital depreciation, and frankly for higher dividend income compared to less, is internationally. So lofty valuations, always a recipe for losing, not always, but a higher risk of losing money than making money. And the fourth L is liquidity risk, which nobody even thinks about. And what I mean by liquidity risk is, I'm an active manager, I buy and sell stocks in the market, and I can tell you that when I'm in the market, and I'm small, I'm only managing $7.5 billion. This is a multi-trillion market, right? So even when I'm trying to buy companies, $50 billion, $30 billion market cap companies, this is not mid cap or small cap, this is large cap, $50 billion companies, it's really hard to get the other side of the trade. Liquidity is not as readily available. This is why, if you recall, in March of 2020, the headline was, not just in the markets had fallen, when the COVID thing, but the fastest drop in the history of stock markets happened in March of 2020. Why was it the fastest? Not because we all understood COVID perfectly. Trust me, we didn't. Nobody did, right? We still don't. It is because when people tried to sell, there was no buyer. And so prices just gap down. So you had and so much money is invested passively. Passive is a price agnostic buyer. They don't care what they pay. Now, when you try to rebalance and you try to sell equities as an asset class, right, you're selling to an active buyer because they are sort of deciding, okay, should I buy Apple? Should I buy Microsoft? Whatever. And they decide what price they want to buy it at. And they don't want to buy Apple necessarily at 33 times earnings. They might want to buy it at 16. That's a 50% correction, okay? So there's a wide gap between what we call the bid and the ask. And when that happens, it's called a liquidity risk. When you can't sell at the price that you want to, it's a liquidity risk. So that's a fourth L. So I hope I've shared with you, what I see as the troubles ahead, and what you want to avoid in your portfolios. But don't get scared in terms of investing. There is a way, as Billy Beane and Steve Jobs showed us, to still make returns without taking too much risk. You just need to know what risks you're taking and to sidestep them. Any other questions? Yes.
So while you're on valuations, so in the last couple of years, the S&P 500 has been driven by the large cap growth stocks, so your Apples, Tesla, Microsoft, and all that. So if you remove those, we have an S&P 495. What does that look historically as far as valuation is concerned?
Sure. So the question is, S&P 500 is richly valued, but perhaps skewed because of the presence of the top 5 stocks, which are supposed to be quite expensive, the high-flying ones, the FANGs. And so what is a valuation if you exclude those 5 stocks, correct? So it's arithmetically, honestly, it's actually not that different. I know the perception is that these top 5 stocks are the richly valued ones. That's not the case. Meta, Facebook in yesteryears, is trading at a discount to the S&P 500. It's skewing the multiple down. And most of these big companies, are actually net cash companies. And so when you look at the P multiple, it does not take into account the fact that on an enterprise value to EBIT, these stocks are actually cheaper. Apple sits on a big cash pile. So yes, the headline multiple is 33. Microsoft, the headline multiple can be 30, but it's much lower. Actually, a lot of the large long tail of US companies are extremely overvalued. And in fact are also extremely indebted. So if you look at the enterprise value to EBIT, which I prefer to use rather than a PE multiple, partly because it captures a debt. Enterprise value is nothing but market cap plus debt. And I told you corporates have gorged on debt. Second, I look at EBIT, earnings before interest and tax, because tax rates might well go up in this country. We got used to the Trump tax cuts, which took corporate rates down a lot. But if you look at the kind of record amount of debt issuance because of COVID, amongst other reasons, there's no choice but to raise taxation. And corporate tax rate might well go up. So that's not taken into account in the PE multiple either, because tax rates can fluctuate. On that basis, the market's trading on almost close to 20 times, which is even higher on some measures compared to the tech bubble time. Because it's not the PE multiple, that can be lower, but it's the enterprise value multiple, the debt. Any other questions?
Yeah, I have a question. Actually,
yes.
2 questions.
Oh gosh.
First question is about, of all the changes that occurred during COVID time, which one of these changes do you think will have the longest impact on investors? The second question is, the changes of the impact of COVID, has it been different on emerging markets and developed markets?
Sure. So I think you heard the question, but I'll repeat it. COVID, what is the long-term impact in general, especially on investing, but also is there any differential impact on emerging markets versus developed markets? Actually, an amazing question, so thank you for it, because I think what COVID has revealed is that work is an activity, not a location. I'll let that sink in for a moment. Work is an activity, not a location. We've all been working from home, right? And wherever else. And so if work is an activity and can be performed anywhere, that's a game changer for emerging markets. Because emerging markets have a lot of educated people, and hardworking people. But if they wanted to get a better job, work, they had to migrate, like I did as an immigrant. And immigration is very hard nowadays for all the reasons that you know. So that path, that a lot of people had for a better future if you're well educated, was just limited. But now, if work can be offshored, and by the way, I grew up in India, as you can tell, telecommunications revolutionized the Indian IT industry. India, like many emerging markets, has very poor infrastructure. Roads, ports, all sorts of things, supply chains, just extremely difficult analog environment to get goods from one place to another. But India had a lot of very analytical people, educated people, English-speaking people, but that talent could not see expression till you had a telecommunications network set up in that country, which allowed you to communicate long distance. And so that gave the birth of the IT offshoring industry, which we completely take for granted. India has never been an exporter of goods like China. China invested in infrastructure, roads, ports, bridges, airports, all this stuff, right? And so that's why India has never really taken market share from the manufacturing, because they have horrible infrastructure. in a democracy, it is extremely hard to get right of way to build a straight road. I know it sounds crazy, but because the rule of law is respected in India, you just get pushback. NIMBY, not in my backyard, right? I mean, all the things that you know, it happens. And so they've always been held back because they are a democracy. But this will unleash. So if you go to Brazil, and I'm just picking random examples here, I mean, it is insane, to be able to go, the logistics of even showing up to work, the cost it takes, the cost of fuel. I mean, it's just really hard. And then women in particular, who have to juggle, as we all know, home life, taking care of even parents, not just kids, multi-generational responsibilities, they need work flexibility. They really do. And COVID has shown us that we can, again, because it's an activity, and it can be DVR'd. We don't have to watch live TV. You don't have to perform work live during working hours only. You can do that. And so I think a lot of these things are going to be actually revolutionary in allowing outsourcing of the service industry, which was never possible before, compared to just outsourcing of goods manufacturing abroad. And so think about it from a very long range. And again, you can see the foresight of Michael and Rod here. They told you to invest in emerging markets, even though it's been one of the worst performing asset classes over the last 10 years. Because you always want to look at what's going to happen in the future. Imagine the biggest thing that holds back any country, any government, any society, is the lack of jobs. If you're able to create jobs because they can be done, it can actually also prove to be another source of disinflation. Everybody thinks inflation is going to go out of control. But what if you can offshore and find labor that is cheaper? And the other thing? Brazil is putting in fiber optic networks at a breakneck speed. Breakneck. Because it's very easy to string fiber. In emerging markets, anything goes, by the way. I mean, you can do a lot, get away with a lot. So you don't have to dig underground to lay the cable, for the fiber and protect it. It's just strung on the poles like electricity used to be at one point. So it's very fast to put it up. And because of that, 60% of the households in Brazil now have access to high-speed internet. Just think about it, They don't have to depend upon the government to create a road, which takes, 3 years to put up, an airport, the money involved. Fiber optic aligned to your home, the monthly bill for your fiber high-speed internet? $10 per month. Game changer, game changer. Here we pay $50. Because, there's a lot of regulation, environmental, I'm not denying that that's all relevant, but guess what? You're unleashing something that people don't even talk about in the media. You don't even hear about this stuff, do you? But these are the things going on in the world. And so being a global investor allows us to compare, all these things, the opportunity set, and look further ahead. And that's why it's really important to be a long-term patient investor. Because short-term, when I was buying some Brazilian stocks of the sort that I'm sort of describing, which are going to be beneficiaries, when a stock is falling and I'm buying more of it, because, the risk-reward is even better, it shows up as poor performance. Because the market's going up, your stock is going down, right? Imagine you had a lot of those. But you're doing right for the client. Because eventually you're going to get better performance, when the market realizes your thesis. Being a contrarian means that you're guilty till proven innocent. It's very hard to do, but it's the right thing to do. So there's lots of opportunity, and COVID is a game changer, not necessarily in the ways that you might think about. Emerging markets, I think it can unleash a lot of potential that was held back. And also in America, you can now get work done in Kansas City. You don't have to be in Chicago. And I'm just giving examples here. Now that you've unleashed it, you will actually reduce income inequality because jobs are going to go where people are willing to work hard and want a better living, and you can offer them that flexibility. So it's a global phenomenon, not just an international one, but it has the most bang for its buck internationally. Yes.
Wonderful talk, Rupal. Really appreciate your insights. You're a non-consensus investor. I'm going to maybe ask you the biggest non-consensus investing question at the moment. What's your opinion on Russia? What's your opinion on investing in Russia right now?
Russia. Oh.
Yes, because
okay.
at the beginning of the year, a lot of Wall Street analysts were saying that Russia, Brazil, South Africa were some of the cheapest emerging markets at the beginning of the year. Now, the past couple of weeks, you've seen some of these Russian stocks, big bank, decline 95% just in a couple of weeks. Do you think it's a time I'm a portfolio manager myself, do you feel it's a time to start looking at putting a little bit of money there, whether, depending what your opinions are on the country at this point?
Sure. So I'll just repeat the question for everybody's benefit. The question was on Russia. It's obviously in the start of the year, a lot of strategists were arguing for. I think I've lost connection. That's fine. I can talk.
Maybe that won't work.
So the question was on Russia and whether it's an attractive buying opportunity. A lot of bank stocks and many stocks have fallen almost 90% plus. So a couple of thoughts on that one. No, I don't think Russia is investable. I think that what just transpired over the last couple of days is a game changer. And what we as a human society could not do for close to 70 years, Russia has done in a week, which is the very thing that Putin was trying to avoid happening, which is keep NATO at bay. He galvanized Europe and has made NATO stronger than ever. And he galvanized Germany, which, as you know, the history of Germany and World War II, so I won't go there, who has sworn off war and, their defense spending is very low. Everybody always thinks they should spend more. Never before have they said we would step up defense spending. And so Germany has stepped up defense spending to 2% of their budget from a lowly 1.5%. And they said that we're going to now start making contributions to NATO. Sorry, Trump was arguing for all this stuff. The Europeans are not contributing. It just all happened in the span of a week. So I just want to put that out there because NATO is the most important thing to preserve for world order as a concept, as a framework. It's one for all for one, so that smaller countries don't feel the need to have nuclear weapons because they have to fight the bigger ones, and that's the only way. Everybody else is going to come to your rescue. It's really, really important what 1 week has done. The other thing it has done is it has turned a lot of people on the periphery of Ukraine who believe that they were Russians, right? They have family. It's right. It's sort of like living in Texas and being close to Mexico. You have a certain affinity just by dint of being closer. And the moment they saw what Putin was up to, and they all sort of thought that, we are Russian, we are belonging to Russia, we are brothers, sisters, overnight that changed. So now, the people of Ukraine, there were a lot of people who didn't want Russians, in the country anyway, but at least at the periphery, they actually were pro-Russian, have turned anti-Russian. So, what he's really done is an act of war. He said he was doing that because, he was trying to rescue and liberate people who asked for his help, the rebellion states on the border. It was all a pretext, which the US and UK called out, of course, and it's shown up now. And so I think the fact of the matter is Russia has now become a global pariah, a global economic and financial pariah, because once you've taken on the SWIFT messaging system, which is the global mechanism for making international payments and receiving them, the country has joined only one other country in the world who's been taken on SWIFT, Iran. You don't want to be in that company. And your biggest ally, Russia's ally, in everything nefarious, sorry to say, was China. Even China has walked away from supporting Russia on this. In a single stroke, Putin has done what we were trying to do all along, break all these nexuses and things. Now look, it's a humanitarian crisis, so I'm not trying to underestimate what has fallen on Ukraine. But since your question was, is Russia investable? No, for all of these reasons. Because once you become a global pariah, all economic activity, which is a source of wealth creation, let's face it, just is completely hamstrung, and rightly so. So this is something that I would say, this is exactly why I say that, low cost is not the same as low risk. Russian equities are the cheapest stocks, right? So they are very low cost, but they're the highest risk. So no, I will not. Yes?
My question is regarding the Fed raising rates. Everybody knows that the rates went up 25 basis points this week. There's promise of a continuing of that. The market responded yesterday very positive because it was half of what they had priced in. What is your outlook regarding Fed rate hikes as well as the timing of them?
So look, it could be 4 or 6 hikes. It could come in 2022. It's all the conventional consensus, talk out there. So I don't have a particularly differential point of view on that front. But I do have a differential point of view is it's actually not the thing to look at. It's not interest rates that's going to take this market down. The rising, because again, as you heard in the original morning conversation, we're so low. This is not going to be the deal breaker per se. That's why markets, even though this news has been broadcast, since late last year, the markets have sort of been okay. The real issue for the markets, in my opinion, is the balance sheet reduction. It's the removal of QE, not so much the raising of rates. And will the market be able to absorb the lack of a backstop from the Fed? I think part of the reason why the market is taking some solace is because of Russia and Ukraine and the energy sort of challenge now of high cost. It's caught between the devil and the deep sea. It doesn't want to get people to panic. A war, and this can still, despite the ceasefire and talks going on right now, it could still turn very ugly. And the reason it could turn very ugly in Ukraine is because most wars tend to be airstrikes, and they tend to be very targeted and, a rifle shot approach. This is a land-based war. Land-based wars are gruesome, and ugly, and just, drawn out. And that's sort of the challenge of this particular thing, that it's a land-based one. And already 6 days into it, or 7 days, whatever it is, Russia has not made the progress that they were hoping for. They thought it would be quick, and it's not. And that's sort of, changing the calculus. So that affects, the Feds and the ECBs, because they are also responsible for maintaining stability. But the flip side, the very thing that is causing them to rethink, how much they should do, how fast, inflation is going even more out of control because energy prices are through the roof and they seep into everything. And so it's like, damned if you do, damned if you don't. Because if you get inflation psychology embedded in people's mind, and it's already becoming embedded, and the Fed seems to be behind the curve, not ahead of the curve, which is not where you want to be. Do you know in emerging markets like Brazil, Peru, LATAM, because LATAM has a lot of hyperinflation memories, they've already been raising rates by 200, 300, 400 basis points for a year now. So the US is so behind, it has so much catch up to do, we found ourselves running out of ammunition. Sorry, not to use that phrase, you know what I mean, optionality. So I think for the market, the biggest issue is not going to be rate rises. I think it's well digested. I'm not saying that it won't matter. I think that a lot of these loss-making companies, leverage companies, is going to be paid. But there are lots of companies that will be fine. I think the real issue is QE, taper tantrum.
Quick thought on cryptocurrency.
Oh gosh. Okay. There is not a conversation I've had for the last 12 months that does not start or end with crypto. So thank you for that question. This question was what I think about cryptocurrency. So first, I think I don't own crypto in my portfolios, so you should know where that puts me. I think crypto is a speculative form of investing. And I think it is more of a commodity than people realize, which is to say it is driven by supply and demand, and a whole lot more driven by sentiment, because it's extremely hard to calibrate fundamentals. The portion of the crypto market that I would invest in, what I'm very, very bullish on, is the underlying technology that underpins crypto, which is blockchain technology. That is going to be a game changer. Because blockchain technology allows you to authenticate transactions because it's a ledger balancing that occurs real time and is extremely efficient. And it is going to revolutionize financial transaction processing. Think about where we need to actually record transactions and authenticate them. I transferred money into your account, I bought a stock, I have to record that the buyer and the seller changed, the money changed hands. This is all financial transaction activity, which is a ledger. And so blockchain technology authenticates a transaction. Today when you swipe a credit card, MasterCard or Visa, sort of authenticating that you are who you say you are, and everything just sort of happens in the back end. And all of that thing, there's still risk of fraud, right? I mean, that's why we get charged sort of a high interchange fee for merchants, because there's a risk of fraud. And so I think all of those things, but it'll take time. Now here's the dark side of crypto. The dark side of crypto is that it requires a lot of energy to produce it, to mine it. And it's just completely upending Europe's ability to reduce greenhouse gas emissions, because a lot of crypto is mined in Sweden. And Sweden has noticed that its electricity consumption has gone off the charts because of crypto mining. So again, this is all the second order, third order effect. All these people, a lot of people, talk about that crypto is sort of going to liberate us from government control, and it's sort of the rebel's way of being rebellious without like taking up ammunition, right? Just express your views. And of course, in Russia and Ukraine, the demand for crypto went up skyrocketing because it's a currency that cannot be debased. I mean, that's the general viewpoint. The challenge is that yes, it cannot be debased by any particular authority, because there is no authority, but it can be debased simply by producing more of it and different forms of it. So there'll be competition amongst different cryptocurrencies. Bitcoin is not the only one. And so this is kind of what creates, this initially a lot of euphoria, and then I think it'll shake out, but that's a long way off. So crypto for now, in my opinion, is a speculative form of investing. So I would not engage. I think we have to call it a close here, and I'm very grateful for you showing up today, and hopefully you had some provocative investment ideas out of it.
Thank you so much. On behalf of the staff of the Catholic Foundation, who did an excellent job, as you all can see, with today, so I do want to say thank you to them, and thank you for sharing your time with us this morning. We hope you found the information very valuable. We're grateful, too, for our sponsors, Georgia United Credit Union and Smith Howard, for your support of our event today. We also want to thank our board of directors, committee members, volunteers, and True Smile with Chris Floral Design for the beautiful flowers. Please designate someone at your table to take the centerpieces home today. We want to thank our presenters, Father Sonny, Mike Petrik, and Fritz Holzgrefe. And then, of course, a very special thanks to our speakers, Rupal Bhansali with Ariel Investments, and Rod Hennek and Michael Butkus with the Atlanta Consulting Group. We greatly appreciate that you shared your expertise with us today. So whether you are an individual Catholic thinking about your own legacy, a professional advisor, or someone who works at a parish, a school, or a nonprofit organization, we are here to serve you. Please call us at the Catholic Foundation to learn more about our services and how we can assist you in making a lasting impact in our community. Thank you for attending, and have a blessed day.